in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities, and welcome to the Friday night show. Joining me tonight on the show is Chris Joy, who is a journalist with the columnist with the Australian Financial Review and a director of Yellow Brick Roads Funds Management, and Roger Montgomery, who is from the Montgomery Fund. If they are here to answer any of your questions about the share or bond market, please feel free to pick up the phone 1300 30 34 35 and the email yourmoney@skynews.com.au. I was completely tongue-tied and got it all wrong. It was all that flustered. And you were the one that was flustered to come in, and you're on on song.
Chris,
sitting there looking $1 million.
Chris is not actually here. He's still.
It's a paper mache. It's a halo. It's a Halloween thing. Let's just talk about how business is. Can I just start with you?
Sure.
How are things going? It's obviously equity world, is volatile.
Okay,
not volatile, but
let me summarise
how's your business going?
Yeah, I'd be delighted to do. That's what I like about this Friday night show. Because we just chat. We just chat.
So business,
it's
very healthy.
The stock market is a difficult place to invest at the moment, and we'll talk about that as the show progresses. And I say that because rubbish is going up, and we don't invest in rubbish, so that makes it hard. We can't find a great deal of value except for the floats. And there's some really good floats, and the reason why I think normally when you've got an informed seller, usually private equity, meeting with an uninformed buyer, us, the best deal is usually done by the vendor. So, but in some cases, in some of the floats, you've got private equity who really stuffed it up last time and burnt a lot of people, and so they're upset. But they've got a pipeline of things they've got to sell. So these early floats that are coming on, they've got to price them really keenly so people have an appetite again.
Because that's completely contrary to their normal behaviour, because that was one of the things I was going to ask.
Absolutely. You don't go to a private equity company and say, look, I can do this for 30 times earnings. The private equity vendor is not going to be saying, no, look, I want you to do it at 20 or I want you to do it at 15.
And then you count how many fingers was it?
That's right.
I'm okay, and you can get out.
My wallet's still here. I've still got my wallet.
Because I was thinking about that idea that I was reading some of the Goldman's paper about the level of money going into the equity market, and it's all that retail money, and it's big, bold headlines, retail money, and that makes me a bit nervous.
Yes.
And then it's 16 IPOs will come out between now and the end of the year, and I think IPO meets retail money meets disaster.
Well,
so
for the reasons I've just described, I think private equity is being a little bit generous in some of these floats, believe it or not. Not all of them, but
Chris,
some of them.
You know a lot of private equity guys as a
I would never characterise private equity guys as generous, to your earlier point, Roger. But
never.
Having said that, I agree with Roger. I think that given the experience pre-GFC, where a lot of folks and post-GFC were burnt buying into private equity exits, I suspect there'll be much stronger alignments of interest in this latest tranche of IPOs.
Really, now we've got.
But they're still not being generous.
Are you prepared to go on the record? And there's only 3 people that watch the show. It's fine.
Well, plus your mum, that's 4.
My mum, that's 4. No, I was counting her. There's a couple of people that are watching this show. So, are you prepared to go on the record as what you think is the generous ones in terms of these listings that you think like is Channel 9 a generous IPO? I used to work.
I think we've seen the papers talking about Vader, for example. That's been, there's been overwhelming demand for that float, and I think that's because it's been priced very keenly.
Also a very good business.
Yeah, and it's a great business. It's a capital light business, credit rating agency. So you're a bank, someone wants to borrow money from you, you ring up Vader and find out what their credit rating is like.
Actually, the banks are electronically integrated with Vader. And they've got a quasi-monopoly on credit scores. Like in the US, they have FICO scores in the United States. And it's basically an outsourced service for some high-level credit analysis for any form of credit, be it home loans, personal loans, whatever.
So just for the viewers at home, just to for those of you who haven't worked in or lived in the United States, credit score is absolutely everything. It drives all sorts of conversations with the bank, with when you want to go to car, you want to do anything. It's what's your credit score, and they talk about it as what's your credit score? Well, I'm here. What's your? It's a weird conversation when you first arrive. You don't have a credit score.
And when we had all those mortgage defaults in the United States, a lot of economists in Australia, a lot of commentators mistakenly believed, well, in America you just walk away from your mortgage.
Yeah.
Well, that's true. You can walk away from the mortgage, but you can't walk away from your credit score.
And also your listed tax rate.
And there's a lot of growth for Veda. There's a lot of growth potential because we're moving to what's called positive reporting from arguably negative reporting. So instead of receiving a list of all the times you defaulted because you're skiing in Aspen, you missed your phone bill. Instead, it's positive. You made your mortgage this many times out of all the payments that you had to make. And yes, positive reporting.
There's also another angle, I think, with Veda, which I've argued for years. There's no, surprisingly, consistent credit score or credit metric across the banking system. So all the banks have different credit scorecards, and it's very hard to compare effectively the serviceability ratios that the banks use to assess credit.
Yep.
So if an independent party like Veda wants to step into that space and try and own it and create effectively the benchmark equivalent of what they call in the US the FICO score, I think that's an option.
An opportunity.
One of the other things I would imagine would be good is if you could then take that credit score that you got derived from your Australian bank and play it out in the United States, because part of the problem is when you go to the United States and say, well, I've had this mortgage with Westpac for 20 years, they say, well, never heard of it. Who's Westpac? And you don't have that transportability of your credit quality. The only people that got into that was the American Express business. Amex said, if you've got an Amex in any other country and you want to go to the United States, we'll take what we deem to be your credit score in your domicile, and we'll give you a credit card. So then people could function. People move over there for work.
Now that's one float. Mobility. There's other floats.
Who owns Veda?
Veda is owned by a private equity group.
Do they have a name?
Yes, PEP.
It's PEP owned Veda.
Yeah.
Didn't Pacific Equity Partners.
How have they gone as a private equity business?
Stunningly well.
Yeah, incredibly well.
And they're going to give you a little,
like $5 billion, right?
Correct.
Yeah. They're going to give you a little handout.
Another one, another float. Just keep moving on because there's a few.
Hang on. It's good to see. We've got an hour. We've got an hour. Don't worry. We don't have to rush into this.
But we have so many breaks now.
Hang on. We are because we're
so
popular.
Many ads.
All these ads. You mentioned it was hard. You said it was oversubscribed. Is it hard for the viewers at home to get onto this?
Yes.
Now, how do they get onto it if
they
it's
can't.
hard? It's impossible.
Correct.
Right. Okay. Now we'll limit it.
For a retail broker.
Hey, look, there's a little bit.
They'll get sanctioned.
There's a little bit. There'll be a little bit. So out of a $300 million float, there'll be $30 million for private investors through their brokers. That's it, and that'll be oversubscribed 10, 20, 30 times.
So will you get Veda?
Yes.
Because of your relationship with your stockbroker,
we're an institutional investor. So
how much money have you guys got now?
About 500.
Gee whiz.
Yeah.
Just growing. So
last time we were on the show, you had 250, I think.
I know.
It's amazing.
It's
scary.
So that's obviously the value out of being in the fund, that you can get access to. That's one of the things we've been talking about.
I think we deserve the growth if we get the returns. By the way, I don't think you deserve to grow if you don't get the returns.
No, we agree with that. So
do you want to know the other floats? Yeah.
Let's have the other floats.
Okay. Well, that's a good idea.
Yeah. It's a bonds versus equities, but no. But it was important because I don't want you to come up with floats that people go, well, whatever. I mean, because one of the great ironies of that, the stock shows, is they talk about stocks that 99% of the people either don't have it or can't.
So here's one that might be interesting that you might
that's why I'm trying to get some value for the viewers.
The one called this is a business called Life Healthcare. Life Healthcare is the distributor of basically nuts and bolts that are put into your spine, as well as surgery tables, but primarily the bolts that go into spines for people who've got ankylosing spondylitis or scoliosis and that sort of thing. They distribute these products for US and European manufacturers in Australia. Right. What's really interesting about this business is that in order to sell a lot of this product, you have to have really deep relationships with the surgeons, because the surgeon isn't paying for the product. The patient who's having the operation is paying through their insurance. So there has to be a deep relationship between the BDM, the business development individual or officer or manager, and the surgeon, because really the surgeon could go with any other product. Mm-hmm. So there's a wonderful long-term relationship that's in place that Life Healthcare has with many of these surgeons. Now, the reason I raise that as a possibility for your viewers is because it's a small float we're talking $70 to $90 million. A lot of fund managers who've got $500 million or $1 billion, whatever, it's too small, and they think, well, why would I bother? It's going to be such a small part of my portfolio, I won't bother. And sometimes it's harder for the banks like UBS or Citi to get that over the line because a lot of fund managers don't participate.
Who's the stockbroker that will be leading that one?
That'll be UBS.
And so you've got to be a client of UBS.
I think so, and fair enough.
Absolutely.
That's why you become a client of UBS. If you want to get access to floats, you become a client of UBS. They're or Macquarie Bank or Citi. The guys who get the floats.
The irony of it is the same with this sub-investment grade bonds that we've been listing. So there's been, I think, 5 issues, about $260 million, and people complain, hang on, I can't get to them. And we go, well, how did we get them to you if you aren't a client of ours? It's just, there's that irony where you spend a lot in the origination piece, you build a relationship, you get the issuer, and then somebody at Macquarie Bank or whomever, I'm not saying they said that, but other private wealth organisations say, can we get a bit of that? Well, hang on.
Yeah.
Roger, can I just quickly ask you, what do you think about Channel 9? What does he think?
I think short term, there's some potential synergies that come from having 5 stations, but long term, I think the economics of that business are unlikely to grow dramatically unless we massively increase the population of Australia.
Gotcha. And it's a challenging business when they, what did they do? What did they actually do in the time where it went under, effectively?
What do you think?
Where it's gone up? How do they
One idea
that?
for Channel 9, they've just bought out 9MSN.
Yeah.
Why wouldn't you create a competitor to Domain and realestate.com.au? And realestate.com.au, I think, is a $5 billion business.
Yeah.
Domain is worth hundreds of millions of dollars. And there's nothing to stop either Channel 7 and Yahoo or Channel 9 now through MSN or whatever it's called, creating an alternative property listing.
The network effect is the benefit of that. You're being first mover, and the network effect combined is very hard to break.
So 2 comments on that.
It's
Firstly,
possible, but it's hard.
The real estate agents have not monetised those listings through realestate.com.au or Domain. And secondly, what about the predecessors to Google? So you can break down network effects.
It takes time. That's why I said it takes time.
Have you seen Zillow? Have you seen that product?
This is my point.
Zillow is an unbelievable product. And in a market where right now, today, if you could launch Zillow, it would go like a ballistic. Yeah. Because the viewers at home, we have to engage all of you, it's not just Chris, Roger and me, is that Zillow was, you could put in a post, you could put in an address, and it was a website that would deliver a price on that address, and it would say that house is worth X, $1 million, whatever it might be. But the owner of that house could also put a price at which they would sell. Yeah. They could put a number up, and you could contact that guy and say, look, I'm prepared to buy.
You were staring out there talking, and I was thinking, who's he talking to? We're over here.
Yes, exactly. Well, on that note, we will go to a very quick break, and we'll try and pay for the show.
First of many.
We'll be back in a few seconds, and we'll have Roger still being very cheeky, so we'll be back soon. Welcome to the Your Money, Your Call, Bonds versus Equities, the Friday show. We're joined with Christopher Joy, who is an AFR columnist and the Director of YBR Funds Management, and Roger Montgomery from the Montgomery Fund. They're here to answer any of your questions. Feel free to pick up the phone and call us 1300 30 34 35 and the email yourmoney@skynews.com.au. We have an email from Mike, and we just want to take that email first because I think we'll talk about the floats, but while they've contributed, we might respond to them.
Sure.
This was an email from last week when we had Matt Sherwood, and can I just take a pause? Matt has promised he'll deliver the books. We had a little bit of a mix-up, so we were swamped. We crashed the system looking for Matt's books with all your emails, so we'll get back to you as soon as we can, but that will be next week, so sorry about that. This is an email from last week. When you speak of reinvestment of dividend, doesn't that depend on the level of return on the investment? A high ROE makes sense because it beats the alternatives, while a low percentage makes less sense because you can do better putting your putting your dividends into alternative investment.
Yeah, so let's take your...
That's Mike.
We need a wide shot here, guys. There we go, wide shot. So we've got 2 glasses here, okay? So both of these represent businesses or bank accounts. Okay, each of them, or a glass of water, and each of them have $1 million in them, and they're generating a 20% return, a 20% interest rate.
You wrote about this in your book.
Correct, it's in my book. That's right. So, but very quickly.
I read your book.
Thank you. All right, I'll keep going now.
Yeah, keep going.
All right, very good. So we've got $1 million in each, 20% coming out. Yep. So $200,000 coming out of this one, $200,000 coming out of this one each year.
Yep.
Very simple. This bank account, the bank has said you must take your interest out.
Yep.
This one, the bank says you can reinvest it if you want. That one gets to reinvest at 20% and compound. This one doesn't. That one is worth more than this one. The one that compounds is worth more.
Yep.
So the question is around, you'd only reinvest if you get very high rates. Well, of course, if I can give my money to Chris and he can get me 20%, and this is only getting 5, I don't want to reinvest it in that.
No,
I'd rather take it out as a dividend and give it to Chris.
That's the classic buffer.
So a company, so here's the corollary. A company, 2 businesses that earn, or 2 bank accounts that earn 5%, the one that reinvests is worth less.
Because you can invest better than 5%.
That's right, than one that pays dividends, because I can invest it elsewhere.
Better at 5%.
Correct.
With cash rates being where they are,
exactly.
That's hard.
And that's how we go about valuing businesses. It's really that simple.
The interesting thing that I wanted to talk to you about, and I haven't lost track of where we're going with the listings, but was in that theme, Chris, I was talking to you about it before, Citibank strategist came out and said, what we're doing, what the viewers are doing is demanding dividends from everyone.
Yeah.
Rio is now a dividend producer, BHP is now a dividend producer, and so those equities that would play a growth role in your portfolio, having got a cash from term deposits, fixed income, that was the role, give you a dividend, is affecting the way companies are acting. Have you got any thoughts on that?
Yeah, I thought it was an interesting argument. So basically he was arguing, or making the point, that with record low interest rates, folks are looking for a substitute for cash out of the equities market, and so companies are focusing on income stability. His concern was that potentially they were under-investing as a result of that, but on the other hand he was saying that within the resources sector potentially we've had some over-investment, so that's not such a bad thing. I guess my point, or my observation on his analysis, is it's all predicated on this view that interest rates will remain very, very low for a long period of time. Of course, if interest rates increase in the future, that dynamic's going to change very, very quickly, and you will be able to get higher rates of return off safer investments. And even if you're long duration and invested in fixed rate bonds and you're suffering some capital losses as those long-term rates rise, as they have done throughout this year, future fixed rate bonds and future floating rate bonds will offer you better rates of return. So I think there's no doubt that I interviewed a guy called Matthew McLennan who runs $80 billion in the US, and he was hitting this topic really hard. That he's
Australian
guy,
Aussie guy,
biggest money manager in the world, who's an Aussie, and he'd never given a media interview before in his life.
And you got
in Australia. I got it, but the one point he was making was he said that the problem with the world right now is we have fake prices. Bond prices are fake. The US Chinese currency cross is fake, and interest rates are fake.
Yep. We'll talk about that. Before we do that, we've got a caller.
They'll be even faker.
Eric, how can we help you?
Hi, Mark. Look, I'd like to ask Roger, on Mike McCarthy, this time, in June last year, I bought 2,000 Macquarie at 24.50. Look, the result today didn't seem to be too bad, but what I'm asking about, is it correct? One share in the Sydney Airport, and Mark, what would you do? Would you sell those shares and buy the Sydney Airport bonds, or keep them knowing that they are loaded with debt? Thanks, fellas.
So you aware of what's happened with Sydney Airport, what Macquarie Bank have announced with Sydney Airport? So they own Sydney Airport at a percentage, I think it's 18%.
I remember when they sold it.
Yeah, so they're going to do an in-specie trade. They're going to give the shares that they have, or they're going to create extra shares in Sydney Airport. And so the Sydney Airport equity was sold off on the basis that there was more shares around, but basically the fund managers will ultimately just sell it straight away because of liquidity issues and because of they want to own Macquarie Bank as opposed to Sydney Airport. So did you have any chance to have a thought about that?
Well, the only issue is what proportion of the fund managers are index tracking, and what proportion of their portfolio can be in the airport security. And if they can't, then they'll sell it, and that'll push it down. But it sells off in anticipation of that.
And the only thing I'd add on the airports is that they're natural monopolies, so they're very attractive. But the problem potentially with some of the capital city airports is they've got a lot of leverage, so they've got a lot of debt, and you just want to be mindful of some of those disruptive future risks. So if there was a second Sydney Airport, what would that mean for Sydney Airport?
Which was in the news yesterday. Badgerys Creek all over again.
Yeah, and I get all that, but that's how long is it going to take?
It'll take a long time to build. It's a big issue.
May not take a long time to price in the equity. So the equities market could...
The equity could get hurt just because of the way equity is. It's just so volatile.
What I've learnt in my time about the equity market, though, is everyone will hold on to the shares and just wait to see if is this going to be the last song they're playing tonight?
Yeah, it's pretty true.
There's still plenty of taxis outside, we'll be right. They wait right to the end.
The thing with the bond, Mike, was that the Sydney Airport 2030s, so 2030 inflation-linked bond, traded today at 4.5% plus inflation. So if inflation is 2, you'll get a senior bond at 6.5%. 6 3/4 if it's 2 3/4. We had a big inflation number last time. So they are, if I look at that asset versus taking on the risk of the equity, I could certainly make a case where I'd be buying some of the inflation-linked bond and maybe some of the equity, but certainly the inflation-linked bond to us, a senior bond, it's clearly much more secure than buying the equity. That's just a fact of life. It does that job.
Yeah, well, I think there's very little risk of inflation in the short run.
But it's not the risk. It's just 2%. Make it at 2, make it at 2.5, but whatever you like. It's in that band. It's been in that band forever and a day.
Correct.
So if I'm at 4.5 and I get 6.5 for a senior bond, I look at term deposits. I look at other investments. Most of the people at home, if they can get 6.5, they're doing well. If they want to,
just to hold you on one issue,
we're about to go to a break. So
it hasn't been between 2 and 3 forever and a day. In 2008, it punched 4 to 5.
Yeah.
Which would be not necessarily such a bad thing for those inflation.
I just don't think that's going to happen again in the short run. That's why I'm
but you're going to stay in that 2 to 3 range for sure. Sure is, God made little green apples. We have to go to another short break, but feel free to call us on 1300 30 34 35 for any questions you have, particularly for me and not Roger. Email yourmoney@skynews.com.au. We'll be right back. Welcome to Your Money, Your Call. It's the bonds versus equities. Joining me tonight is Christopher Joy, an AFR columnist and director at YBR Funds Management, and Roger Montgomery from the Montgomery Fund. They're here to answer any of your questions. Feel free to pick up the phone, 1300 30 34 35. The email, as you know, is yourmoney@skynews.com.au. And we have our second caller. How can we help you? I'm hoping he was there. We've been talking about...
we'll have to move on.
We might. When you want to call back, he is gone. He just wants to talk about
that happens. Nature called.
Yeah, that's right. We were just chatting for too long, too many ads. So the IPOs. We've got a couple of minutes before we go to the next break.
Very quickly. Look, you mentioned earlier, you just talked briefly about how the change in dividend policy of Australian companies, the increase in the payout ratio, and the payment of more dividend, and what that means. And then let me talk to you about what it does do to equity valuations. And I don't mean prices, I mean valuations. When a company like ANZ this week increases its payout ratio, and they've gone to almost 70% now, the shares have been going up. And the shares go up because everyone's chasing yield. So people see the higher dividend yield, they look at what they're getting in their term deposit and they think, gee, that's better. They bid the share price up. The problem is the value of the business is now lower.
Because you're not
the valuation is lower. Yeah, because you've got less money being retained and compounded at 15%, 16%, 15.3% in the case of the ANZ. You've got more money being paid out to people, and so the value of that business is actually less. So you've got this odd situation where the share price has gone up, but the valuation has not gone up as much or has even gone down, and that increases the risk.
So Roger, are you negative on sort of our return on equity expectations for the major banks? Do you think they'll be able to maintain those sort of double-digit mid-teen ROEs in the next 5 years?
I think it depends on how crazy people get in the property market.
Because they're going to, the RBA's got to stop those guys. They've got to stop the crazies. I mean, you've got some views on.
You've got a bubble view.
We're going to talk about that after the break, but you've got some serious views, and I get that now because you look at some of those numbers that came out this week. Property development.
I argue that Peter Switzer has absolutely smashed me relentlessly for even talking about these risks on this station.
Because he just doesn't want to hear that there's a chance there's a bubble.
And it's not that I think there's actually a bubble. I've argued the market's price of perfection. And if we get another 12 months of this double-digit rate of annualised house price growth, the Aussie housing market will be more overpriced than it ever has been in recorded history. That is indisputable. So we're not far away from that point, and we really can't afford to, I think, confront that sort of situation with household debt-to-income ratios or household leverage also near historical highs, but the cash rate and mortgage rates at record lows.
And when you talk to anyone, the builders are really busy now, the prices going through, you talk to the people in the real estate business, it is absolutely charging, everyone's happy, and you feel like the Scrooge in the room saying, guys, can't you see that that's not quite where we're supposed to be? And what are they going to do? If they lift the cash rate, the currency goes through the roof, and then everyone loses their job. And it's it's a kind of weird scenario.
Can I just read a quote? This is from John
I think
Kenneth.
we're going to be going. Yeah, but that's fine.
John Kenneth Galbraith. He wrote. Break.
They're going to wrap me up on a break.
Another break.
We'll have to go to another break. I do beg your pardon. Feel free to give us a call and say, listen, no more breaks. We'll be right back. Welcome to Your Money, Your Call, Bonds versus Equities. Joining me tonight is Christopher Joy, AFR columnist and Director of YBR Funds Management, and Roger Montgomery from the Montgomery Fund. They're here to answer any of your questions. Feel free to give us a call. As you know the number, I keep repeating, 1300 30 34 35, and email yourmoney@skynews.com.au.
So let's start a conversation about bubbles and property, right? Because I think people are interested
really
in that.
Important. At the moment, that's real. You know, that is just so.
I think the seeds of a bubble are germinating, but I think we're some way off a bubble. And let me read this. This is from the book by John Kenneth Galbraith, who is a Canadian US economist and diplomat, and he wrote a book called The Great Crash. At some point in a boom, all aspects of property ownership become irrelevant except the prospect for an early rise in price. Income from the property or enjoyment of its use or even its long-run worth is now academic. What is important is that tomorrow or next week, market values will rise as they did yesterday or last week, and a profit can be realised. So when people throw fundamentals to the wind, then you start getting a bubble. Now, let me just say this: in Mossman 2 weeks ago, I think it was Rain and Horn sold a block of flats in Mossman for there was a one three bedder, two two bedders, two one bedders.
A block of flats, okay.
Block of flats, okay. It sold in 2009 at the depths of the GFC for 2.9 million, and the buyer sold it last week, I think, for $3.52 million. Gross rent, $135,000 gross.
Really?
Gross rent was $135,000. Now, if you take away anyone, you got to pay your maintenance, you got to pay tax, then you've got to pay to the real estate agent the management fees. But if anyone was borrowing money, even if they borrowed 50%, and most people borrow more than that, but even if they borrowed 50%, at 5%, you're making no income return on that at all.
Yeah.
None at all. So you are speculating. You are speculating on capital gains.
So this is,
by definition, that's the seed of a bubble.
He can make 2 points
if I could just make one quick comment. So
make it slow.
This is
plenty. You've got an hour.
This is a really valid observation, but I think one of the key interesting insights for me on the housing market, well, actually two. The first is the influence of the self-managed super fund market. So there's $500 billion of cash in self-managed super. Only 3.5% is invested in residential housing, because historically you couldn't borrow in SMSFs. You now can. That's changing. I speak to banks all the time. They're seeing a big increase in SMSF demand to borrow.
Does that permanently lift the base, though? Like a 14,000 first home buyers grant, right? It permanently lifts the level.
It's called a level effect, not a growth effect. But here's the second point, which I think viewers need to understand, and that is to your point about the prospects for capital gains. If people today are expecting capital growth through their holding period of say 5 to 7% per annum, and we roll forward in 2 years' time, and the RBA lifts rates say 200-300 basis points or 2 to 3 percentage points,
affordability goes out the window.
As housing prices did in 2008 and 2011, they fall say 5% or even 10%. And if capital growth expectations shift downward permanently from say 5% per annum to say 1% per annum, you could have a 10 to 20% fall in Australian house prices without any increase in unemployment.
Right, but now
we've already seen
it. Take the devil's advocate on
it's happened just recently.
Yeah,
in the US, it's never actually happened in Australia before. Right?
Yeah, well, hang on a sec. I know houses that were bought for $15 million and people couldn't get a bid at 8.
Yeah, but that's not what we're talking about. We're talking about the across the curve.
No,
we're talking about
the broader.
It's the SMSF guy has got $1 million and he uses that money to buy a property.
Yeah.
The thing, I can understand what you're saying, and I do agree that that's a potential, and I don't think that people should be buying property with their self-managed super fund. But if they're buyers and the way they treat these super funds and they continue to work, they don't really have the same sort of price pressure. And so what they do is they just sit on it forever and they say, oh, well, we've lost money, but we'll move into it all. It'll be, they'll buy it out at Terrigal. It's going to be the retirement place. And so I think I think the bank shouldn't be lending to these guys. I think it's a mistake.
I worry that everybody thinks you got the mass market believing. So the GFC, it was the top end that got hit.
Yes, right.
Yeah.
The guys who didn't get a bonus at Macquarie or whatever. Yeah,
absolutely.
But
that's
now
I'd
it's
say one statistic.
Is
now it's
anyone
the
from
mass
Macquarie
market.
Bank's watching this show? Can you send me an email because I just want to catch your name?
The mass market now believes that they're all going to make money out of property, and they're buying because of a fear of missing out.
Well,
right?
I don't know. Well, we can't speak for the mass market, but I feel that they buy because of, it's the home they want. So some of these.
But they're
commercial
investors. They're buying for as an investment.
Yeah, but
Sorry,
Let's make a couple of points. The first point is that median house price in Australia is about $430,000, right?
Yep.
Less than 5% of all homes in Australia sell for more than $1 million. The $15 million plus market irrelevancy, right?
Yes.
The second point is that housing has been a great bet for a very, very long time. In 1991, in the recession, when unemployment hit 11%, national house prices actually increased over 1991, 92.
Yeah.
So in our recorded, or in our lifetimes, we've never seen a major housing correction or a major drawdown. The second point is, wait a second.
1970s onwards.
On the SMSFs, the rosy view of the world is one you articulated, which is these guys are going to hold forever and it's going to be stable capital. The not so positive view of the world is that self-managed super, which could bring, I think, up to $500 billion in demand if once they gear up, right? So if they only put 30% of their portfolio, which is $150 billion, they only use a 70% loan.
Yeah, it's exactly
$500 billion.
It's $500
billion demand. Here's the rub. These guys are investors. They're not putting roofs over their heads.
That's exactly the point.
So they could
They're
cut their losses much more quickly, and they could actually increase the volatility in the housing market.
Sorry,
not
who would cut it off? The banks.
SMSFs.
The banks would cut off.
No.
The SMSFs. Okay, I'm with you. Hang on. I'm with you. I got all that. I just might have missed the last bit. I get the fact they're investors, but I also feel that they buy for their retirement. So it's the places in Port Macquarie, it's the places at the beach.
But if they've borrowed and interest rates go up,
I get that.
And they're getting a negative return,
do they cut their losses and go into something
what
else?
happens?
Or do they just do what everyone did? They just didn't sell, just paid off their debt. They just continue to pay off their debt.
No, but they're retired. They need the money.
No, I'm not saying
they need the money.
Guys who haven't
It's never
retired.
existed before. This is the point. We've never seen it.
Can I make two observations just about house prices? One of the things that we know is if we actually plot the number of 49-year-olds compared to the number of 69-year-olds, accumulators versus dissavers, then what you find is the multiple that people pay for shares and the multiple that people pay for houses over rent, it tracks that ratio, and the ratio is plunging. The number of 49-year-olds compared to the number of 69-year-olds is plunging. So the number of dissavers is increasing.
Cool. So the bottom line is bad for equity, good for bonds.
Yeah. Clearly. It's clear. The equity market is...
That's a really important point.
It is absolutely fully valued. I mean, all these people are saying, I want to buy into equities, and I say, you just keep getting older every day.
But your point, Roger, is that for the 1990s and 2000s, we were an accumulation society.
Correct.
We were building our super balances.
Everyone's building their super.
The baby boomers are moving into retirement, and they're now pulling down that. They're dissaving. They're pulling down that money. And so the likelihood of them paying a premium for high growth asset classes like equities is reduced.
Well, the other issue is that you've got a whole when interest rates go up back to normal levels, you've got a whole generation of people who only last year were crying they couldn't afford a house. You've got a whole generation that need to liquidate their house. Who are they going to sell to? Now, people have run me and said the Chinese. They're going to buy it. Well, that might be true. And we'll wait and see.
Yeah, and it's a big buy. If as you say, 20% drops in the property market, which I'm not saying is going to happen. I'm just saying. I'm of the view that you need to have a balanced portfolio, and if the first thing you do with your self-managed super fund is to stick it into property, we have a problem. More people should watch the show, and they will after the break. So we'll be right back, and we'll take a very short break. Talk to you soon.
Yeah, careful.
There we go.
Japanese equities.
Well, we're cute. Welcome to Your Money, Your Call. It's a Friday edition of Bonds versus Equities. Joining me tonight is Christopher Joy from the AFR. He's a columnist there. He's the Director of YBR Funds Management, and Roger Montgomery from the Montgomery Fund. We're still taking some calls if you care to call, 1300 30 34 35. Email yourmoney@skynews.com.au. I want to move away from a little bit of the local commentary and just ask you about the tapering. You're a Fed watcher. You're obviously very connected to the RBA as well. In the roles that you play, you get to talk to a lot of those guys. What's your thoughts on the new Fed chair come in? What's your thoughts on tapering?
Well, I'm think I'm going to agree with Roger. I think that
How do you know?
Janet Yellen is what is known as a nominal income targeter, and this is actually a really important. It sounds complex, but it's a really important new concept.
Let's explain it to the the 5-year-olds that's watching, or 10-year-old.
So basically, what's happening is in the old days, central banks and groups like the RBA used to target inflation and try and maintain price stability. But then what they found was they could have price stability that actually encouraged instability, and you got imbalances, and you got asset price booms and busts, and you can have periods of very low growth or negative growth with stable prices. So that price stability and inflation targeting wasn't good enough. So now
Explain what do you mean by price stability?
Keeping inflation basically between that 2 to 3% per annum band.
Yep.
But the crux of the Yellen and nominal income targeted view of the world is they now want to target activity. So the central banker, which is like a benign dictator sitting out there, is basically saying that it's trying to engineer a particular rate of economic growth through the cycle. And the problem with that, of course, is effectively, I think policymakers are trying to diversify away business cycles, and there's natural volatility in the business cycle that we actually need. So 2008, equity values halved. Effectively, I think that was market signalling to us that we need to allocate that capital away from financial services businesses and other related sort of bubble correlated industries to more productive parts of the economy. The central bankers have intervened and said, no, we want to basically
help Goldman's.
We want to help the financial institutions. We want to support asset values, and we want to avoid a very, very aggressive adjustment. So the concern is they're kicking this stuff down the road, and we're going to have an even greater bust at some point in the future.
So Janet Yellen, we know, is going to be the chair of the Federal Reserve. What many people don't know is that the woman...
Just 1 second. Is there any chance that she won't? She'll get through the banking? Is there any chance that the Republicans will say, hang on, because you've done it with...
slim.
They've
very
done it with
slim.
The latest one is the Fannie... No, the Fannie Mae, Freddie Mac. The authority that runs that, they've just done the... you have to have the 60 people vote. You have to have 60 senators have to vote.
Can we just get on with this?
Well, no, but it's interesting. No, the Republicans have stopped Fannie Mae and Freddie Mac from doing their business. That's now today, and so that's real. So that if they
what you're saying is that they don't want a dove.
Yeah, that's what I'm saying. They're talking about what you're thinking, and would they then say,
No, Yellen's talking about what we're thinking.
No, in terms of the boom, the bubble that will hit.
So the Republican, I think they're preferred, as I understand, is this guy, Donald Conn, who is not as dovish as Yellen. To be honest, I have no idea what's going to happen in terms of her nomination.
Yeah, I think, look, most people...
We have to take a call. We have Brian calling. Sorry for interrupting our conversation. Brian from Gladstone. Hello, Brian. How are you?
Good, thanks, mate. Just can I get the opinion of the boys on Australian stocks with majority international earnings in large markets compared to Australian stocks like some of the local banks where the majority of their earnings is within Australia. The only other comment I'd like to say is Helen will not be Yellen.
Okay. All right, so very quickly, the issue is not whether the company earns its profits in Australia or overseas. The question to ask is it a great quality business? If you believe that Glenn Stevens is going to be able to jawbone the Australian dollar lower, and then you'd be delighted to own great quality business that's earning US dollars. So a CSL maybe. If you don't believe the analysts and you think the long-term prospects for Cochlear are going to be great, fine. If you think interest rates in the US are going to go up and the Australian dollar is going to drop, then maybe QBE is an option as well. And so you would look at that. But if you don't believe that the Australian dollar is going to drop, and then it doesn't really matter. You look for great quality businesses irrespective of where they earn their revenue.
Great question. Sorry, you wanted to say.
All right, so what I wanted to say, just to your point, and I think this is really important for Australian investors, because if you read, other than your article, if you read everyone else's columns, they're talking about tapering and the dangers of tapering and that sort of thing. But if Yellen takes the chair and she's no longer vice chair, then the woman who may take her place is a woman named as vice chair, is Christina Roma. Now, Christina Roma recently gave a talk at Johns Hopkins University, and only on October the 25th, so we're just talking late last week. And what she said was very, very interesting, because what she's talking about is this regime change. So switching from inflation to nominal GDP or GNP is a regime shift.
Absolutely.
And they've looked at Abe, who came out and basically sacked the governor and two others, and said, right, well, we're getting rid of this deflation situation. This is what we're going to do. They then looked at Mario Draghi. Mario Draghi, the most famous 7 words.
I will do
whatever it takes to save the euro.
And he did.
And so they're talking.
What's Roma saying?
So Roma's come out. Really interesting.
Christina Roma was on the Obama Economic Committee. She was the chief architect in 2008. So
Correct.
she's instrumental in coming up with the strategy that was, but we'll give all the money to the banks and we'll look after the Main Street later. So Wall Street got looked after.
So, and this brings us back to bubbles, okay? It brings us back to bubbles. I'll quote what she said last week at her lecture. Switching to this new target would have some important benefits. In the near term, it would be a regime shift. It would unquestionably shake up expectations. Since we're currently very far below nominal GDP path based on normal growth and inflation from before the crisis, it would likely raise expectations of growth and help spur faster recovery. Now, I know how scary that sounds, but listen to this. Today, I worry, and this is somebody who could be Vice Chair of the Federal Reserve, today I worry that guilt over letting asset prices reach the stratosphere in 2006 and 2007 has made some policymakers irrationally afraid of bubbles. As a result, they focus on the slim chance that another bubble may be brewing rather than on the problems we now face.
It's absurd.
Isn't that scary?
These guys are just living in a completely different universe.
They're living in a bubble.
This is the problem. So the viewers understand, what she does is she literally takes a ruler from before the global financial crisis, where the world adjusted and said, guess what, guys, you got it totally wrong, and you need to shift this capital and this labour and these people, we need to move them to other industries that are making things and that are productive and are not just reallocating risk, which is what financial services does. And she's taken that ruler and she said, well, actually the world should have just continued on in a straight line.
From that point.
And guess what, we're way below our nominal GDP level, and so therefore we need to do everything humanly possible to get back up there. But the truth is...
You've got Summers, the alternative possible chair of the Federal Reserve, who says that the Fed's policies hasn't done anything to asset prices, has no effect on asset prices.
But we will go to another break, but before we do, the RBA is as culpable. Absolutely. When you read the RBA, this is where we are in terms of price. We are in a below trend. I hate this below trend. We are what we are. Deal with what's in front of you. Our currency's too high.
Can I say one thing quickly about the RBA? The RBA has taken the last 20 years of its own forecasts, and it's discovered that it cannot forecast growth, unemployment, or inflation beyond 12 months. So whether we're at trend or slightly below trend, whether GDP is at 3% or 2.6%, it's an irrelevancy. It's statistically indistinguishable.
Yep.
And I think what the RBA should be doing is focusing on tail events and extreme crises and trying to mitigate those events, but not trying to over-engineer the business.
And trying to move people from one industry to another, which is what they did with the mining boom. We are going to take a very short break. We'll be right back. I hope you're all enjoying it, because I am. Talk to you soon. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. We've got 4 minutes. If you've only just joined, you should already know who they are. Christopher Joy, Roger Montgomery. Let's start with you first.
All right, very quickly.
You've got 2 minutes.
So we've inflated this bubble, and there's a risk of greater inflation. Out of the top 100 companies, I can find 4 stocks that are cheap.
And they are?
Now, they are Fortescue Metals,
Really?
JB Hi-Fi.
You always buy that.
JB Hi-Fi, Orica, and Leighton's, and you wouldn't touch those, given that there's 96
Leighton's is just extraordinary.
96 of the top 100 companies are expensive. That tells me the market is at very real risk of falling, and if it doesn't fall, there's not much risk of it going up a lot.
Okay,
but
we'll go to you. Hang on. What do you do with your cash? I mean, that's the problem. As the people I know that invest with you said, listen,
better not to lose money. Better to earn 3%, not lose money. Our cash weight at the moment is about 20%.
And what's your maximum cash weight?
We can go to, in the private fund, we go to 100%, and in the retail fund...
What are you in the private fund?
In the private fund, we're 25%.
Don't you think it should be a bit higher if you think it's massively overrated?
Listen, I'll tell you some TDs and some bonds. Right,
this is the top 100, not the smaller stocks.
Let's talk about geopolitical. You are the guy that was at the forefront of all this sort of stuff. We've got China, we've got Japan, there's a little bit of sabre rattling. Do you want to talk to the viewers about what you think's happening there?
I just think that the probability of major power conflicts, so war between China, Japan, Pakistan, India, China, South Korea, North Korea, is much, much higher than most people assume. And the problem is we extrapolate out from the recent past. So we've actually lived through this really unusual period of peace and prosperity since World War II, where we haven't had major major power conflicts. But history teaches us that the probability of conflict is actually reasonably high over a span of time. And the problem is we're moving from a world where the US was a dominant power, where now it has this great rival in the form of China, which is not a liberal, open democracy. It's a one-party political system that's basically a corrupt oligarchy. And they're hell-bent on preserving...
Chinese viewers at home, I hope you missed that first.
Yeah, apologies for that. And you probably won't like my article on the front page of the AFR tomorrow either.
Plug.
So it's a plug. But it is a real problem for investors, because I never hear financial advisors or institutional investors talk about mitigating this sort of catastrophe risk, because if we have, and by the way, our four biggest trading partners,
because it's a tail risk you can't time.
But how do you mitigate it? How do you mitigate?
Well,
do you just buy local and you buy fixed income?
I think there's an argument for not diversifying for the sake of diversifying. So again, we've avoided Japanese equities, South Korean banks, Chinese banks like the plague. I mean, it's a no-brainer, right? Particularly given what we're seeing in the last week and what we've frankly seen over the last 12 months, in the Senkaku Islands and the various territorial disputes between these nations. So I think that don't diversify for the sake of diversifying. Think about cash. Think about assets that protect you against deflationary shocks and inflationary shocks. So gold and cash, I think, are interesting.
Can I just, if somebody says to me, Roger, why am I paying you to be in cash if you can't find value? Well, because we track the value of every single listed company in Australia and around the world, we can assess the time that there's value and the time that there's not. If you're sitting at home, it's much harder to do that.
So we can plug that. This is a really important point, because I've heard the same argument of other managers, and the fact that you can go to, I think, 100% cash in your fund. I'm happy to, not that I'm an investor, but I'd be happy to pay a professional money manager to time my asset allocation between cash and equities.
We're at the coalface. It makes sense.
It's impossible for a mum or dad to do that.
It makes perfect sense. If we can't find value, there we are at the coalface, staring expensive stocks in the face. We are the best positioned to make that decision.
Yeah, and do you send that out in the blog? I mean, I noticed that you didn't mention it on my show on the blog, but do you send that out on the blog?
No, we mentioned it on Twitter.
Oh, did you?
Yeah, we put it out on Twitter.
We are going to wrap up. Thank you so much to all our guests. I've been told to get off. Thank you to all the viewers and the phone calls. Until next time, I'm Mark Todd from FIIG Securities. Thank you to Roger and Chris for joining the show. Watch the AFR tomorrow.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise